Van Sciver, what a day we're gonna have with Tesla here.
Yeah, well, one, I would say it's a true vindication of your process. I remember yesterday at the meeting, you're like, we were at an all-time high 4 days ago, and coming in, we buy down here when the signal is positive, and got the first green light. And this is, that was definitely sniffing out this report. This is the lowest quality earnings report. And I know that sounds like a tedious thing, but for those who like financial statement analysis, rarely does one see every single lever get pulled. This is one for the financial reporting history books. Tesla, I think it's always important to note, doesn't have a normal CFO like external who came in. It's a former VP from Solar City, and Solar City was not a company known for its financial reporting. This is a company that 2 weeks ago held a autonomy event where they faked the robots. This was widely reported, where humans were controlling them without much disclosure to that effect. And it's a company where, in the quarter, I know the stock is up, so you need to step back and just say, what happened? Headline auto revenue grew 2%, rounding up, and excluding deferred revenue, it fell year over year. So this is a company where their core product revenue is down. And when you think about what is the standard way companies create, particularly 30, 40, 50 years ago, how, what would Buffett have said accounting fraud is? It's when you capitalize an expense. It's where you put an expense on the balance sheet. And that's overwhelmingly here, what's happening. And people stop doing it because it's really obvious, right? But Tesla's balance sheet items are obviously discontinuous this quarter, right? So inventory continues to grow. That's one we've flagged for overproduction. But prepaid expenses, which is just sitting in the current assets line, doubled since last year on flat revenue, right? That's
Really?
not right. Receivables are up 25% on, again, a 2% revenue increase, most of which is from deferred revenue. So a slight non-deferred revenue decline. Depreciation is running at less than half of CapEx, right? That's the standard capitalizing expense, right? On flattish revenue. So why are you spending an extra $4 billion to add capacity in order to have no revenue growth? Secondary indicators, if Tesla were killing it, if they're making all this money, why would they cut R&D? Why would they cut SG&A, right? They're taking restructuring, right? This is a company that is basically on a trailing 9 or 12-month basis not generating cash. Especially if you take cash flow from operating activities minus CapEx minus stock-based comp, which is a real expense. You could have had cash or stock. You don't have, in the trailing 9 months, it doesn't generate any cash. And it isn't growing. So I don't know what everyone thinks they own. I think this is obviously a quarter where Elon felt like he was under tremendous pressure coming out of the autonomy event, given his political involvement, and didn't want bad news, because this was otherwise positioned to be a pretty bad quarter in many respects. The Q came out this morning. I'm still going through the text compare. But the reason why people don't like shitty accounting, right? And this is a real reason, something that we're seeing from Ryder this morning, which is actually our number one short, right? So Ryder is guiding down. It's in every respect a pretty lousy quarter and guide. And the problem for if you own Ryder is that this is just the start of a large runoff of things that they did in their accounting in 2019 to 2021, right? It just takes a little while to play out. So, they're cutting, there's consensus at 360-ish, and they're cutting, to basically 340, and that's just for the fourth quarter. It really gets going for Ryder in 2025. So the problem with putting earnings on your balance sheet or pulling earnings off a balance sheet is that the balance sheet is generally not infinite. And that's basically what, if you capitalize an expense, you're just putting that expense on the balance sheet. Eventually that rolls back off. So, beware that this is, I recognize that people are going to be all excited about Tesla or whatever today, but this is not a company that actually in any sort of underlying operating basis is either making money on a trailing 9-month cash flow basis or including all the stock-based comp that you paid Elon, or I don't know, just if you don't do all these things, if you don't capitalize your expenses, and it has consequences. And I think you'll see that in just looking at the pre-market indication. I think you'll see a lot of pressure on Ryder today, and probably much more of it into 2025. And we have like a million reports, like Rollins missed by a penny. That's probably a good thing because they were accused of manipulating their earnings. Another company that actually had to pay a fine and settle and fire their CFO. People may not care, but if you're actually going to bother to read the financials and go through them, you should note that, like, oh, Rollins missed. Why'd they miss? Well, they had to fire their CFO because they used to not miss. They used to cut, and it was literally, it's in the SEC settlement, that they used to basically adjust earnings to hit numbers. So it's probably good that Rollins is missing. Ryder is guiding down because of something they did years ago. Tesla is beating because they don't have a real CFO, I would say, but you can interpret how you will. It's still down year to date, and it's down probably 30-something% since its peak in 2021, and market's up near an all-time high.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.